This week, Bank of America sent a private research note to its wealthiest clients, not retail investors, not the public, the people who pay thousands of dollars every year just to access this information. And inside that note was one warning. A policy panic is coming, and the investors who are positioned before it hits could make the kind of returns that normally take a decade in just a few months. Now listen carefully. This is not about predicting a war. It's not about guessing headlines. It's about understanding what always happens next and why the next 30 to 60 days could be one of the most important investing windows in the next 5 years. Right now, markets are falling. Oil is rising. Confidence is collapsing. The S&P 500 is down from its highs, the Nasdaq is sliding, and most investors are doing one of two things: panicking and selling, or freezing and doing nothing. In 6 months, both of those decisions will look wrong. Let me simplify what's actually happening. Oil prices are high, but bond yields are falling. That tells you something very important. The market is no longer afraid of inflation. It is afraid of recession. And when that shift happens, everything changes. Before this, markets were pricing higher inflation and higher rates. Now they are pricing economic slowdown and rate cuts. And when the Federal Reserve moves from tightening to easing, a very specific group of assets moves first, fast and aggressively. This is what institutional investors call a policy panic, the moment when governments and central banks step in and markets reprice upward very quickly. So what triggers it? First, any sign of de-escalation. Even a small signal can push oil lower and trigger a strong market rebound. Second, central bank intervention, liquidity support, bond buying, the same playbook used in past crises. Third, government action, stimulus, policy changes, coordinated response. Any one of these can trigger the same result: a sharp and powerful rally in the assets that were hit the hardest. Now, here's what most people miss. Smart money is not chasing what already went up. They are positioning in what has been beaten down. Not oil companies, but energy infrastructure, pipelines, storage, transport. Not short-term trades, but defense and aerospace, because government spending continues for years. Consumer stocks at extreme pessimism. Historically, that's where strong recoveries begin. And software. The AI trend has not stopped, but these stocks are being sold like it has. So here's the framework. Separate what is actually damaged from what is temporarily mispriced. That's where the opportunity is. 3 simple rules. Don't chase what already spiked. Follow signals, not headlines. And remove leverage so you can survive volatility. The investors who build wealth in crises are not the ones who predict them. They are the ones who understand what comes next. The bottom may not be in yet. Markets could fall further. But that's not what matters, because when the policy panic arrives, the move will be fast, and it will reward those who were early. Watch the signals, ignore the noise, and position before the world reacts.